I've never seen in my career such wide dispersion between performance as separated by geography and by asset class. And I think we're going to continue to see that over the next couple of years. There's about 2.1 trillion of commercial loans set to mature. We think about 600 billion of that, or 30% of those loans, are potentially troubled. And we categorize that as a loan having an LTV of greater than 80%. So that's a significant amount. I wouldn't say that we're looking at a full sales sector meltdown.
This show spans global markets and institutional investments through conversations with some of the world's leading investment, economic, and philanthropic minds. On this episode of the FEG Insight Bridge, we welcome Eric Rosenthal, founder and managing partner of Machine Investment Group, a private real estate manager. Founded Machine in 2020 after spending nearly 2 decades in investing across real estate equity, debt, and structured finance. Prior to Machine, he was a managing director at Garrison Investment Group, where he led real estate originations across multiple strategies and market cycles. Eric has built deep experience navigating stress, dislocation, and complexity throughout the capital stack. On today's podcast, we hear about the incredible founding story of Machine and what they had to overcome. Finally, learn how this cycle differs from other real estate investment cycles. Eric, welcome to the FEG Insight Bridge.
Thanks for having me, Greg.
Would you mind introducing yourself and Machine?
Sure. I'm the managing partner and co-founder of Machine Investment Group, an institutional manager focused on distressed and special situation investing across the United States. Our firm pursues opportunities across both the primary asset classes, such as office, industrial, multifamily, and some of the specialty asset classes, such as senior housing and hospitality.
I know a little bit of your story, and I know you had to overcome quite a bit to get Machine off the ground. Would you mind kind of sharing that personal story?
Yeah, so going back, for somebody that spends much of their day searching for dysfunctional situations, my upbringing was wonderfully stable. I grew up in suburban Washington, D.C. in a town called Vienna, Virginia. My father was originally a commercial real estate broker, turned retail investor, and my mom was sort of a consummate health and wellness entrepreneur. So I had great mentorship growing up. I wasn't a particularly good student until I found a love for history in high school. And that really helped me find purpose beyond athletics, which had always dominated my reason to exist. From high school, I attended the University of Virginia and graduated in 2007 and began a real estate career in New York.
Let's fast forward a little bit to founding Machine. You get Machine. You have this plan. You have a partner that you're going to launch this with. Mm-hmm. What happens?
Our story begins with a successful decade at a predecessor firm in New York, where I met my co-founder Andy Kwan in 2010. Andy was 8 years my senior, but we became fast friends and eventually co-heads of the real estate business at Garrison Investment Group, which had a very similar mandate to the one we hold today at Machine. In 2019, Andy and I were offered a $75 million seed investment from a state pension fund to launch a new real estate platform. And by January 2020, we were sitting in shared office space in the West Village of Manhattan, formulating this new business plan on paper. We were 60 days or so into it, and then the world shut down. We had a wonderful pension partner who, in fairness to them, was trying to figure out which way was up and whether or not they wanted to continue to move forward with the capitalization of this business during the depths of COVID. Nonetheless, come August of 2020, we emerged with a commitment. We closed on our first deal, and we had quite a bit of capital raising momentum behind us. We had closed a few former investors and a few new investors, and we're off to the races, notwithstanding sort of the chaos around us, which was at the same time creating quite a bit of opportunity. It was March 21st, 2021. I was having a Sunday morning conversation with Andy, which was our ritual. We typically caught up on Sunday morning for coffee. And recapped on the week and the week ahead. And in this particular conversation, it was a wonderful and happy celebratory conversation about a very likely pending capital commitment from a large institution, which really would have turbocharged our business at the time. And instead, unfortunately, later that day, Andy suffered a brain aneurysm at 44, and he left 3 young children and a wife widowed. So it was a very challenging moment in time.
So what happens then? I mean, business partner, your friend, you've got commitments. What happens to Machine to keep it moving, or even with you personally?
Well, I took a couple months and really worked on myself. and worked on my team and made sure that there was support. We worked with professionals, and we did a lot of soul searching to make sure that we were there for Andy's family. I was there for my colleagues and there for myself. A lot happened. I think as I reflect on it, I was in fight mode and making sure that we were acting as the best fiduciaries we could, because at the end of the day, we had live capital and investments out there. But from a personal standpoint, it was a very, very challenging time. Andy was one of my closest friends, and he had been a partner of mine for over 12 years at this point. Somebody I talked to, as you can imagine, many, many times a day, and spent a lot of time with his family. As I look back, I sat down with our investors, our anchor investors and otherwise, and I said, what do you guys want to do here? I said, that fire burns deeply within me to keep this thing going, and I'm inspired to do so. I think back to a moment sitting in the hospital with Andy after he had fallen ill. He was in South Carolina on spring break with his family, and I was holding his hand, talking to him, and I said, we're going to do this. We're going to continue what we started, so long as others support us to do so. We're gonna do this in your honor, and we've continued to do that. And I'm happy to say that in March of 22, after putting the fundraising on pause for about 6 months, we emerged with our first closed end fund commitment of about $250 million, with another $200 million of co-investments stable to that.
Well, thank you for sharing that very personal story. And I would just say, I looking back at all your materials, I know even in your latest fund offerings, there is a page for Andy at the back. So he is gone but not forgotten.
That's right. Andy was a force. He was an All-American soccer player at Duke. He was the life of the party. He was a hard-charging, wonderful investor, and he's missed. And I laugh with him often as I still talk to him, as you can imagine, look up at the sky. That was a twist, as was COVID, and then we had to welcome Chairman Powell in the spring of 2022. So between the first couple years of the launching of this business, we had 3 pretty distinct events, which were challenging to say the least.
Yeah, investing's hard enough. You don't need additional challenges that are external to that. So, Machine now is a successful commercial operation, ongoing, and what is the unique character of Machine? So what makes Machine different than maybe other private real estate peers?
There's a lot of talented investors out there, and many of them share a similar opportunistic mandate. But I'd put our ability to source and execute complex transactions up there with anyone in our industry, certainly within the middle market. Almost everyone in our firm comes from a workout or credit background. So inherently, as a result, the majority of our deals involve some sort of distressed capital stack, whether we're buying a non-performing loan, buying a distressed asset, opportunistically lending. The things we do, we find alpha in complexity. I'd say in general, our firm has intense curiosity that's broad-based, coupled with superior drive, or what we finally call hustle factor. We often say, I love the saying, hustle increases luck surface area. And we hustle around the country. We turn over stones with such a diverse mandate. It's important that we're on a plane. I'm proud to say that I've got status, the top tier status on 4 airlines as the managing partner of the firm.
I'm not sure you want to brag about that.
And that's not
sure it's worth
well, it's
it.
not unique. It's not unique to the deal team. We all spend a lot of time on the road cultivating relationships across asset classes, across geographies. The human element is what I think differentiates our firm. We approach this business with as low of an ego as possible, and a high bar for curiosity.
Oh, that's great. Would you give us maybe a past example of a Machine type of deal where you're kind of bringing in the complexity and curiosity?
Sure. I can think back to a deal we did during the middle of COVID. It was a hospitality opportunity, a structured credit opportunity. There was a lower middle market REIT that was struggling to survive as their leisure-dominated portfolio continued to recognize cash flow losses, as did many folks at the time. We were approached by a banker who was trying to raise $30 million of common equity for this REIT to help stop some of those funding gaps. We looked at it, and we didn't think that was an appropriate risk-adjusted profile. We thought about it for a couple of weeks, and we reapproached the company and said, how about we provide you a bespoke $30 million preferred equity loan? that preferred equity loan sat behind the senior secured mortgage debt at the property, but ahead of everything else, ahead of the common and the preferred securities. And the reason we did that is because we thought that entry point provided about a 65 to 70% attachment point on loan to value. And to the extent that the world didn't recover, this company couldn't pay us back as we expected, we feel very comfortable owning the assets at that basis. In fact, the numbers told us we would make more money if we foreclosed. Ultimately, we were repaid. We were repaid with a very strong minimum multiple, well inside of the projected maturity date. And that's because we had certain structural covenants that put pressure on the company that were motivated to pay us back. And as we all know, the leisure market recovered more swiftly than I think many of us anticipated, certainly than I did. So we generated highly opportunistic returns, in this case, a multiple on invested capital north of a 1.6, which for a credit position is quite strong.
Very strong.
So when we get involved with credit, we really like to drive multiple. But that's an example of that was a sort of an underloved, underappreciated firm. And we took a different approach to an opportunity that was out there in the market.
So you're being opportunistic. It sounds like you'll use credit, but you hope for downside protection or preferred equity, something, but you want equity-like returns even when you're doing that.
We want equity-like returns. That differentiates us between traditional real estate credit providers. We have a harder time finding traditional credit entry points because of that multiple profile, but we do find it.
All right. Tough question for you. Mm-hmm. Why are you called Machine? What's the genesis, the story of the Machine name?
Right. So neither Andy or I wanted our name on the door. We agreed to no geographic references or street names. And we had an investor in jest that referred to our investing style as machine-like. So we adopted it. And in a world of chaotic, distressed investing, it's supposed to convey our unemotional, data-driven, process-oriented approach to allocating risk across a diverse mandate. And also, your listeners may not like the name, but one of the things I did remember from my marketing classes, you may not like it, but you'll remember it. So we thought it was a differentiated name that would stand out. And as we grew the business, people don't tend to forget it.
It's definitely unique, and it is also, as you point out, very difficult to name investment firms. A lot of the names are already taken. One other thing maybe that it feels a little bit unique to Machine is really your focus on the middle market. Mm-hmm. So maybe define the middle market, and then also what are the pros and cons of investing in the middle market?
Sure. I think the middle market is a broadly used term. For us, it really comes down to deal size. Mm-hmm. We invest pretty broadly across the top 40 commercial MSAs, and that's because that's where we find residual liquidity to be most robust. It's easy to fall in love with the tertiary market that you may want a vacation in, but there may not be any institutional capital. So we tend not to invest in those kind of places. But we've been active in places like Nashville and Jacksonville, mm-hmm. in Kansas City, and the list goes on, and gateway markets as well. For us, the middle market's really about deal size. We like to write equity checks between 10 and 30 million on average. I've been doing this for a long time, and the institutions that we've competed with have gotten, on average, very large. Most don't want to get out of bed for an equity check less than $50 million. So we find a lot of dysfunction and less competition. We're typically competing with fundless regional operating partners or smaller regional investment operations in our deals, so we can move quickly with discretionary capital and take advantage of those situations. So for us, it really comes down to deal size, and we really see a lot of white space writing smaller checks and taking advantage. And on the flip side of that, you asked about challenges. We spend as much time talking about not just the risk-adjusted returns of a deal, but the opportunity cost of doing that deal and what kind of pressure it could put on our firm. We may have 15 or 17 investments inside of one of our vehicles, and we need to make sure that nothing capitalizes on too much time. We need to make sure that we're picking appropriate investments that our asset management team can successfully execute on while looking for new opportunities.
No, that's great and very helpful. We started out in the beginning here. You gave an example of kind of a machine type of deal, and it was kind of came out of the sort of COVID, right? We are in 2026. However, it still feels like COVID has cast a long shadow on the real estate market and it's changed a lot of things. What has been the lasting impact of COVID on the real estate market?
Lasting impact. There's a lot of things. I mean, if we think about, sort of the differences between the GFC and some of the stress we saw in COVID, during the GFC, we saw really a drop in net operating income and EBITDA at a property level. We haven't seen that in this cycle. We've seen a wholesale reset in value, really starting with the Fed's response to inflation and the historic rapid rise in rates beginning in the spring of 22. Asset values in general are down. Consensus tells us they're down somewhere between 15 and 25%, depending on geography and depending on asset class. And that's really a math problem. That's really a residual capitalization problem. For many years, the debt capital markets were quite weak. They've ripped back. In 2025, origination values were up almost 50% over the prior year. So the debt capital market aspect has really rebounded. But we saw a lot of different things happen. We saw asset classes be impacted in different ways. Obviously, hospitality and senior housing saw income impacts early in COVID, and today those are rebounding quite well. Multifamily saw a tremendous amount of supply with basically low risk free rates and overbuilding in many parts of the country, which have now sort of manifested themselves in late cycle distress, even though the world has sort of found its footing. Office, of course, is a longer conversation we could have a separate podcast on to discuss. Office is something that we've avoided in general because we don't think the risk-adjusted returns necessarily support the opportunity set. That's a broad-based comment, and we are looking at office opportunities. But I would say the biggest takeaway for me is dispersion. I've never seen in my career such wide dispersion between performance as separated by geography and by asset class. And I think we're going to continue to see that over the next couple of years.
The question for you is, coming out of 22 in COVID, I would get a pitch book probably almost every day about this wall of maturities, this bad debt that was just everywhere, right? It was on banks, it was in the CMBS market, and there was just going to be this massive opportunity to play, commercial private real estate through the debt market. And there's been opportunities, right? I mean, and you've played in some of those, but it wasn't this tidal wave that everybody expected. What happened?
Yeah, sure. So I'll take a step back in my career. I came out of college and I worked for a public mortgage REIT called Gramercy Capital in New York. I graduated in 2007, so I had about a year of high octane, frothy, late cycle originations, lending on office, hotel, senior housing, you name it, around the country at high attachment points. We got called into a conference room about 12 months after I started, and half the firm got laid off after Bear and then Lehman. I spent the next 3 or 4 years flying around the country, foreclosing and taking assets through bankruptcy. I lived in a hotel in Niagara Falls and I operated it. I foreclosed and operated on a shopping mall in Silicon Valley. The same goes for land in California, office in Texas, multifamily in Texas. You name it, I touched it and operated it. And it was this very unique experience at a young age. And I was recruited to my predecessor firm in 2010 to go on offense and buy non-performing debt. And I give you all this background to say in 2010, through about 2014, there was this huge opportunity to buy non-performing commercial paper coming out of the GFC. My firm bought about $3.5 billion, close to $4 billion of non-performing debt. And we were one of 2 or 3 firms that were very active in the space. Opportunity set's way different today, and it's been way different emerging from COVID. What we saw post-GFC was this wholesale puke. We saw banks, special servicers, insurance companies sell portfolios of loans, $50 million, $100 million, $500 million at a time, and that's the stuff we were buying. At Garrison, way different in this cycle. I would argue the problems are the same, in some cases worse, but the way in which these problems have been dealt with has been way different. I point to a couple different things. There's been less regulatory pressure under the current administration. Post-Silicon Valley Bank and that failure, there was a serious fear factor and contagion. Without getting too much behind the curtain, what I can tell you is we get calls. We have as good a connectivity with special servicers, special asset officers at banks, people that work out trouble loans, that call us and have pretty frank conversations all the time and say, I'd like to discuss this issue, this loan with you, but it's not for sale technically. We don't want an offer in writing, but we want to discuss it. The way in which things have been worked out in this cycle are way different than we saw post-GFC. That's to say that the pig is moving through a python at a much slower rate. Between 2025 and 2027, there's about 2.1 trillion of commercial loans set to mature. We think about 600 billion of that, or 30% of those loans, are potentially troubled, and we categorize that as a loan having an LTV of greater than 80%. So that's a significant amount. I wouldn't say that we're looking at a full-sale sector meltdown. Yeah. But back to our middle market orientation, while there are less large pools being resolved, there's plenty happening down market. There's plenty of small onesie-twosies getting resolved by regional banks, by insurance companies, by special servicers. So we're staying plenty busy. So I think the headlines are correct, but I think if you dig into it and you talk to firms with a mandate similar to ours, you'll find that there's plenty happening down at the ground.
Yep. So ones and twos, not this big tidal wave, but look, you said it earlier. You need to find 15 to 17 great investments, and there's probably plenty of those out there. Distressed or not distressed, right? You have the opportunity to play that, but you only need a couple, right? Versus setting up a special $15 billion fund to work out bad debt in commercial real estate. That doesn't seem like that's a viable option these days.
It doesn't, and some of the larger deals that have traded, there's been some large non-performing loan pools that have traded from banks. Those have been gobbled up by the largest asset managers. And our view, understanding that collateral and underwriting it directly, is that the yield profile and risk returns are coming dramatically down because those managers with larger pools of capital are having to find something to do. So we're just seeing way better risk-adjusted returns on some of these smaller opportunities than we are their larger scale deals.
Yeah, I should go back and I shouldn't have said viable, because they are viable. They're raising these funds, probably not profitable for the end investor, or at least maybe the profits that they'd hoped for. Right? It seems like they're going to be kind of lower, and it's not quite the opportunity. So as we kind of sit here today in 2026, what's kind of the current health of the commercial real estate market on kind of more of a macro level?
It's complicated. I think we're seeing quite strong income growth. As I said, the debt capital markets have rebounded, and that's very important to the functional health of our industry, to buying and selling. But there's still a large bid-ask gap. Transaction volumes are up. And closer to their pre-COVID norms, but still meaningfully behind 20 and 21 volumes. And I went back to something. I'll go back to something I said earlier. Dispersion is the word that we talk about. For a long time, geographic allocation typically led to return outcomes. Yeah. I over the last couple of years, and I think going forward, it's venture to say it'll be asset and sector specific allocations will drive returns. So pick a region and pick an asset class. I'll have a different answer for you. Yeah. As we sit around an investment committee table, we'll tell you that we like Austin for multifamily, even though there's in specific zip codes. We just bought a deal there. But we don't like it for office, and here's why. And we have that same conversation up and down the capital stack around the country by asset class. It's really dispersion oriented. And one of the things, this is not a red state, blue state comment, but it's become increasingly challenging to invest in certain parts of the country with political instability. I take Los Angeles, for example. Los Angeles has a lot changing. We saw the actors and writers strike. We saw we saw the horrific fires. But we've also seen a minimum wage CAGR, or growth rate, almost double to the next closest market in the country. Yeah. It makes investing very, very challenging in these certain pockets. In our annual meeting recently, we invited a government affairs person to speak with our LP base, which was quite an odd thing to do. Typically, we have an economist or a sector-specific person. And we did that to reflect our growing concern and focus on stroke of the pen risk and things both regionally and by asset class that we can't control. You may have seen in the last week or so, the White House announced some potential impacts on the single-family rental market. Things like that. You got to be prepared and look around the corner and really think about how some of these different moving pieces are. So that's a long-winded way of saying it's complicated.
No, I like the detail. Thank you for that. Well, let's maybe move to. I think it's the hot dot right now in real estate. It seems like data centers are the place to be. However, there are probably a lot of considerations you have to take in mind before you invest. Could you kind of share? I know you've played a little bit in this space. How do you think about that, and what are some of the I think everybody knows what the opportunities are. What are the risks that you have to think about before you get into development?
Yeah, it's an exciting sector, one that's moving quickly, but also one that comes with a lot of risk that we take quite seriously. We have focused on defunct and or unloved industrial or corporate campuses that have power today and power now.
And that's the key, right? You have to have power.
You have to have power. The power constraint and bottleneck is well understood. I think what we believe is underappreciated is the transmission risk. It's one thing to understand that there's generation capacity within a region or a submarket. It's another thing to get that power there, to get a substation built and turn it on within a reasonable time period that keeps a customer engaged. One thing we've seen, whether it's a hyperscaler or a neocloud, growing user AI or cloud, is that they want that capacity today. And if you can't give them that capacity today, they could make a different decision in a quarter or a month or a week. What we focused on is very deliberately finding assets hiding in plain sight that have power today. So for example, we bought Merck Pharmaceuticals corporate headquarters about 8 miles from Newark Airport in New Jersey. That was a 2 million square foot life science campus. At the time we bought it, we weren't particularly excited about what was happening in the life science market for reasons we can discuss. But what we were excited about was of 60 to 80 megawatts of stranded power that were on site at the campus. Eventually, we monetized that wattage. We converted a lab building to a powered shell, and we sold that building and we sold some excess land to return the entire basis in that transaction. Today, we own about 1.5 million square feet of real estate without any capital basis, and that's because we were able to monetize that. We have more recently bought a distressed manufacturing facility in Pennsylvania. These were 2 former printing manufacturing facilities that had power today. And again, that's the difference. What we've been looking for are accelerated power stories, opportunities that do not have a lot of transmission risk. But at the same time, all of these things come with risk, and we take them very seriously. And I'd say that the bar is very high. As the technology moves as quickly as it does, we want to make sure we stay on the forefront of good stewardship.
No, I love that. I mean, and I'm glad you hit on power, because the build a spec data center somewhere and not have power, or have power available but not transmission, because the stories that we hear is sometimes the wait's multiple years. You might even have an agreement, but to get it on site and actually working, and in that point in time, obsolescence, competition, and you really have to kind of strike. So it's interesting to hear that from you, and it's also interesting to hear that a lot of these deals seem to be conversions, right? You're finding industrial buildings that have power and repurposing them. And is that the kind of the best way to play that versus buying a bunch of land and putting these things up in a cornfield somewhere?
I don't want to say it's the best way, but it's the best way for us.
Yeah.
We are not sector-specific specialists. What we are very good at is finding special situations that have the opportunity to drive alpha. To answer your question, if you have power and you have a structure and you can turn that structure on, you can lease it. And we've proven that in what are otherwise probably previously described as tier 2 markets. The 2 largest positions we have are not core data center markets. However, upon proving that we had the power, we almost immediately leased those assets to users. So I think it's a big differentiation for us. Not only I'll say too, I think we're seeing, experiencing, hearing, and living through a public pushback on this use around the country. We're starting to see increasingly zoning become an issue for folks, even in established data center markets. The consumer is worried about what's inside that building, what it's going to do to their utility rates, what it's going to do to their local water usage and cost. We talk about power generation, we talk about power transmission. We should now also be talking about zoning and general political risk, and the timeline for actually getting a structure up in place. So to answer your question, we find it very advantageous in the cases the deals we bought have structures that we can power and have on-site power that exists today. So that differentiates our go a little bit. But there's plenty of talented developers out there that have a better perspective than I do on a segment that I think is here to stay.
No, that's great. We talked about what I think is sort of the hottest area in real estate, really, is data centers. But if I would have went back a few years ago, I think the cool kids would have probably been multifamily, especially in the Sun Belt, and probably life science. And so I wanted to, you mentioned multifamily in Austin you like, but you don't like office. Maybe we could kind of peel that back a little bit. It just feels like multifamily is very much overbuilt. And so is it really truly market by market? Where are we with multifamily, and where would you play in that potentially?
Yeah, it is market by market. I think we have a very favorable view. We're still undersupplied, underhoused in this country. But regionally, by market and by zip code, we've seen a tremendous amount of new supply. We're excited about that because we can pick certain locations, certain geographies, certain MSAs and zip codes that we want to go strike. We've bought about 2,500 apartment units in the last 18 months, and all of that has been through the debt. We've bought non-performing loans, and we've either foreclosed or negotiated a deed in lieu to get to the asset through the debt. If you take a step back in the multifamily arena, in particular, from 2017 through 2021, before the Fed changed their rate policy, there was an explosion in predominantly syndicator deal flow. You had people buying assets not only in the Sun Belt but in the Midwest and in the Southwest at 3 caps and 4 caps. They thought that rents would grow at 8% forever, and they would exit that investment at a 3 or 4 cap. Well, the music stopped in 2022, and today one of the biggest opportunities we see is buying distressed, non-performing multifamily debt. There's a lot of it out there,
and I love that. So when you said multifamily in Austin, I'm like, what? That sounds terrible to me. Like, that's a really overbuilt market, but it's a great city, right? And great population growth, great business growth. But that's the opportunities through the debt, not the equity. In my mind, I'm like, oh gosh, why would you want to do that?
Yeah, sure.
But to restructure something in Nashville or in Austin, that seems like a great opportunity.
Yeah, well, if we talk about Austin in particular, this asset was built about 14 months ago. The lender pressured the borrower to resolve it. In fact, it was actually a subordinate preferred equity lender that mandated a sale of the asset, and we ended up buying it at about 30% discount to what it was built for 14 months ago. This market has experienced a tremendous amount of supply. This zip code in particular, we bought an asset in Georgetown, Texas, is the fastest growing city in the country. And that's not an exaggeration. For the last 2 years, it's experienced CAGR rates in the 6 and 7%. So we're making a bet on this submarket and this part of town, given the job growth in North Austin. We believe that the absorption rates will catch up and that concessions will normalize. But as we look around the country, we like to find, within multifamily, we like to find good assets with bad capital stacks. As I said, going back to 17 to 21, there were a lot of assets, quality assets that were bought, whether they were workforce housing, they were Class B or relatively recently delivered Class A. A lot of good assets we can get our hands on that had bad over-levered capital stacks. So this is just a function of finding a motivated lender, finding a borrower that's ready to walk away or has walked away from an opportunity, and just resetting basis. And I think that's the key in multifamily for this cycle. Reset basis, buy quality assets, make sure you have your arms around the CapEx situation, and move forward, because the underlying fundamentals in this country from a housing perspective still remain very strong. some of the financial over-leveraging we experienced over the last couple of years have just distracted us from that.
No, that's great. That is good. So we hit on multifamily. I feel like the other area that was really hot for a while was life sciences. You put them up in some suburb of Boston and then put another one and maybe Austin as well. Where are we with life sciences?
There's some green shoots with some of the momentum in onshoring rather, particularly in the Carolinas and parts of the Northeast. But in general, it's very, very tough. Yeah. It's so tough that we found it almost impossible to pull the trigger in this arena, at least at this point. There's probably going to be as significant loss severities in this asset class as anything else. Office gets all the headlines. And what I mean by loss severities is as a percentage of lender loss severities, as a percentage of UPB or par, what these loans will sell for, what they will be worth, what the REO will be worth at the end of the day, will probably be a significant discount as any other asset class. There's way too much supply. For a long time in this country, we were building 4 to 6 million square feet of life science supply. And then over a 3 or 4 period window, we decided to deliver 40 to 50 million square feet. There's just too much supply.
And this, the thing with many life sciences buildings is that they're built out so unique, right? That it's really hard to reposition them as multifamily or retail. They have, labs, they have, special, not all, but a lot of them are very unique. And so they're probably only, their best use is probably another life science player without significant new capital going into them.
That's right. And remember, the underlying credit quality for some of these tenants, even if you can find them, is typically venture-backed or otherwise.
And it does feel like we're coming out of it a little bit, but we sort of had this, biotech nuclear winter for many years where coming out of COVID, a lot of these companies were overfunded. And maybe we're working through it now, but it seems like a lot of stuff was built in that kind of those halcyon days.
Yeah, well, we have spent a bunch of time with the venture capital community. It does seem like possibly one of the swiftest benefits to AI could be in biotech arena, for sure. Within precision medicine. Yeah. But that's even changing the use case. Biomanufacturing is getting a lot of conversation around our office as much as traditional lab and R&D is, but still not enough demand. We think it's going to be a very prolonged workout cycle for this asset class, huge loss severities. And as somebody that typically licks their chops when there's an opportunity like this in front of us, we don't know exactly what to do with it because we just can't figure out the demand side of the story. So it'll be pretty interesting to follow.
Yeah, I think it's just pretty interesting how the real estate market has evolved in that, we are this far along and haven't talked about retail, haven't talked about office. I know those aren't really areas you focus on, but I just think the real estate market has really changed. There weren't data centers before. Industrial has become a big part of it. It's interesting. Where do you think, is that trend going to continue, or is there something new that you kind of, how will the real estate universe change and expand over the next handful of years?
Yeah, it's a great question. We haven't talked about office, but given my vintage, I'm just turned 41. I grew up as a value add office investor. I think most people my age, my peers with the cost of capital that I had were in the same boat. Probably 50% of what I did was buying an office building, renovating it, leasing up to new tenants, and selling it. Yep. At Machine, we haven't bought a single office transaction. So I know the office business really well, perhaps too well. Yeah. We look at the landscape of just relative risk-adjusted returns, and we struggle with that asset class. We'll do some office. We're getting closer. But if you go, pre-COVID, the Odyssey Index or core exposure for institutional real estate investors, office represented about 40% of core holdings. Yeah. Today, that number is sub 20%, and investors would love that to be sub 10%.
Zero, maybe.
Industrial, I believe, was somewhere around 14 or 15% pre-COVID, and today that number is high 30%, 37, 38%, something like that. So you've seen a wholesale change. It's part of why industrial volumes, even through this distress, have remained quite high and above of pre-COVID averages, just because they're replacing sort of that core exposure in the Odyssey Index. I do expect to see continued dispersion. I've used that word a couple times. Alternative asset classes like senior housing, data center, self-storage, retail are continuing to grab headlines, and for good reason. I think the fundamentals in those sectors and the residual liquidity offered are more enticing and easier to underwrite.
Well, even retail has changed. I mean, it used to be malls, right? And now there are a handful of malls, and some malls in certain areas are making a little bit of a comeback, but it's a much smaller universe. It's more these outdoor kind of lifestyle, retail centers with that have, some hospitality, and they have restaurants and a few stores in it. But even retail's 100% different than big box stores that probably a lot of real estate investors grew up doing. If they didn't do office, they did retail.
That's right.
And that's completely changed.
Yeah, that's
completely changed.
That's right. Yeah, mixed use is
yeah.
Sort of its own asset class at this point, and it used to be coupled in with a lot of different things. So I agree with you completely.
I think it's fascinating because I just look at some of the stats and the changes over time, and as someone who follows everything, right? So I'm not doing real estate every day. You see these numbers, and you're just like, holy cow! I mean, the makeup, and you pointed it out, for office 40 to 20, and someone will probably wish there was 0. Like, it's completely changed the universe of real estate, and it's fast. But it's pretty exciting too, like data centers and just self storage, cold storage. I mean, there's just so much out there that's kind of unique and new.
I think one of the things you'll find in our office is just a high level of intellectual curiosity, and I think that can be said for any successful investor. But we love what we do because we're highly curious folks that like to bob and weave around the country, up and down the capital stack, and by asset class. And you're absolutely right. There's never been a time, at least in my career, that's provided more opportunities for exploration. And there was a lot going on and a lot changing fast.
Well, we really appreciate you coming and kind of sharing your real estate wisdom and knowledge. Wanted to end on a few just maybe personal questions, because I think people are always kind of fascinated, about people outside of work. So, what is a fun fact that nobody knows about you?
A fun fact that nobody knows about me? Well, I don't think nobody knows about me. My wife certainly knows, and some select friends. But on my walk to your office this morning in Cincinnati, I passed Grader's ice cream.
Yeah.
I'm an ice cream aficionado.
Wow. And Grader's is one of the best.
And Grader's is one of the best. I've been known to eat ice cream not just after dinner, but sometimes sneaking it in the morning.
For dinner, and maybe ice cream for dinner.
For dinner, for breakfast. But I tend to find the local ice cream shop in whatever part of the country I go to.
All right, so this leads to a very important question. What's your favorite ice cream?
Man, my favorite ice cream, regionally, I think New England is hard to beat. Okay. In Massachusetts, there's an ice cream shop called Mad Martha's that I think is hard to beat. So if anyone's in Martha's Vineyard over the summertime, I'd highly recommend.
All right.
You try Mad Martha's.
Favorite investment book?
Got to be Money Game by George Goodman.
Yeah.
Who wrote under a pseudonym of Adam Smith. I think it was published originally in the late 60s or 70s. It was given to me by a mentor when I first joined Wall Street. I've read it a couple times, and I love how it dissects how investing is as much about an exercise in mass psychology and emotional drivers as it is the study of the actual underlying asset value. So
a true classic.
That book to me is a classic.
All right, hobbies.
I'm an avid sports fan. I love playing sports. I'm an avid golfer, skier. I'll watch just about anything on TV.
And you played football at UVA, right?
I did. I was an accomplished high school player and not so accomplished college player. I was humbled, but I did, and it had a very impactful experience on my life. So I'm grateful for the opportunity.
And as you mentioned earlier, Andy was a soccer player at Duke. So two college athletes, probably very competitive.
We were very competitive.
Yeah.
We were very competitive with each other. It was a lot of fun, and I missed that day to day. But we've managed to recruit some other highly competitive folks to the team at Machine, and that continues to be the case.
Oh, that's great, Eric. Thank you again for being on the Insight Bridge.
Thanks for the opportunity, Greg.
If you are interested in more information on FEG, check out our website at www.feg.com. And don't forget to subscribe to our communications so you don't miss the next episode. Please keep in mind that this information is intended to be general education that needs to be framed within the unique risk and return objectives of each client. Therefore, nobody should consider these to be FEG recommendations. This podcast was prepared by FEG. Neither the information nor any opinion expressed in this podcast constitutes an offer or an invitation to make an offer to buy or sell any securities. The views and opinions expressed by guest speakers are solely their own and do not necessarily represent the views or opinions of their firm or of FEG.